Hey guys, welcome to today's session. Just give me a moment to get everything set up and let everybody else join, and then we'll jump straight into it. If somebody in the Discord could just confirm that you can see my screen and hear my voice, that would be absolutely fantastic. I'm just going to ensure the stream is working elsewhere as well. Okay, perfect. Let's get started. So, guys, welcome to today's session. If you've not been to one of these Wednesday sessions before, this is where we take a look at all the metrics that are available on your Darwinex Zero or Darwinex account. We take a look at some low-hanging fruits that might be staring you in the face when it comes to your data and your metrics that you may not know about it. These sessions are my favorite sessions to run on a weekly basis, and the reason they're so great is because we look at statistically backed variables that maybe that you've not looked at before. So a lot of times when I'm working with traders, especially at Darwinex, we have or I tend to come into a lot of issues where traders are too technically heavy. Now, what I mean by that is traders will build a system or a strategy based on a technical aspect or something that they see on the chart, whether it be a chart pattern, indicator, whatever it may be. And they tend to break it down to its most common denominator, which is if I see this pattern, I'm going to execute and do XYZ. I'm going to manage it in this fashion. And they get very laser focused on that one variable, which is the chart. Now, I am a huge believer in the fact that you have to take on information from so many different variables that the chart is just such a small part of any trading strategy, especially when you have a history or a trading history and trades that you can look back on and data that you can look back on. Now, I've been trading for over 6 years myself, and before I was a trader, I was a data analyst. So this is kind of my favorite thing to be doing, is kind of looking at strategies from a statistical perspective, understanding what the trader's doing well and what the trader could improve on. Now, it's very difficult to make any justified decisions because I'm looking at a strategy from an unbiased perspective. I'm only looking at the data. I'm only looking at the statistics that we have. I don't see how the trader executes. I don't see why they execute. But for the purpose of this session, I don't really care. I'm only looking at variables that you might never have looked at before. So what I'm going to ask now is, I like to do this for somebody here, so at least there's somebody who takes immense amount of value from these sessions. So if you're watching in the Discord or on YouTube or Twitter or whichever platform that you're watching on, I would really appreciate somebody putting their hand up and saying you can analyze my Darwin. Just send me your 4-ticker Darwin and I will load it up on the screen and we can get started. If there's not anybody, I understand, not everybody wants their track record public. I get that and completely respect it. So if there's nobody, we can take a look, just kind of more, in a generic sense, we can take a look at the metrics and we don't have to do a live example. Okay, so we've got somebody in the Discord. I'm not even going to attempt to pronounce your name. I am already attempting to pronounce your name. Zoaxito. Let's take a look. LJGF. Okay. Now, the only caveat to this is I usually say, IJGF. I usually say a minimum of 6 months record is kind of what we really need. How long is this? Okay, so we've got like 4.5 months here. So we will do it. We will take a look at this record and we'll take a look at your history and see if there's anything that we can spot. The only thing is, to make any justified decision, you kind of need to have seen your strategy through, a longer period of time than this, unless you're extremely active as a trader. I generally like to see a strategy perform through different market cycles. So, high interest rates, low interest rates, a bull run, bear run, whatever it may be, just so that you know that the integrity of the strategy works over a long period of time. However, having said that, I appreciate not everybody has a track record that long. So we'll work with what we have, but just bear in mind that things that I say and things that I suggest, because your record's only 4.5 months, just take it with a pinch of salt and just go, okay, is it an anomaly in the data, or, you know, and should we let this play out for a little bit longer before you make any justified decisions? So to begin with, you're managing 110,000 euros in DarwinIA allocations. So fantastic work there. Well done. 16% return with a max drawdown of 4.5%, or just under 4.5%. So really, really good metrics to begin there. You start with 30k, 60k, now gone up to 110. So that's a 50k allocation. So great work there. All positive months thus far. It's fantastic. Let's take a look at an actual breakdown of your strategy. So you're not too frequent. I mean, what's your daily trade frequency? 5.41. Okay, so yeah, so you're a scalper. Average losing trade duration is 1 hour and 15 minutes. Average winning trade duration is 36 minutes. Okay, we'll come on to those statistics in a minute because I think there's something interesting there. 82% of your trades come on commodities. You've got your additional details locked, so I can't take a look at them, which is fine. We'll just do it by asset group. So 82% commodities, 15% CFDs or indices, sorry, and 2% forex. So we won't even worry about forex because it's such a small portion of your trading history. But if we just take a look at the commodities to indices, so you're a lot more active on commodities, and actually this is pretty. It's pretty good, the ratio of trades to return. So what we wouldn't want to see here is the much smaller, well, sorry, the less amount of trades generating a higher amount of return. Generally, that's not a good sign. It means you haven't optimized your asset for the frequency. So as far as the record should look is generally the more trades that you take in one asset, the more return it should provide. Otherwise, you're doing a whole load of nothing or a whole load of work for a whole load of nothing. So believe it or not, we see this quite often where a distribution on asset might be like this. So you might have 82% on commodities and only 16% on indices, but their indices have, you know, produced a 10% return and their commodities have produced a 2% return. And you'd go, well, there's something not quite working out there. You know, you've taken 4 times the amount of trades, but you've only made 2%, whereas without taking that amount of trades, you've actually made 10%. So there's sometimes a bit of a discrepancy there. But here it's actually, you know, the way it should be. The least amount of trades that you've taken on FX, you know, it's basically nothing, but the lowest return. The next is indices. So you've done a 2% return with 62 trades. In fact, no, I'm not going to bother working out the math, but I think it's pretty standard, really. I think still you're probably more profitable on commodities, but only slightly. For example, if we were to times the return by the amount of trades that you had done, the amount of trades that you've done for commodities, your return would probably look very similar to what it is on commodity CFDs right now. So there's nothing to concern me here. You've got a great win rate, 64.5% on indices and 71.3% on commodities. Arguably, you know, over time, if you're not generating enough of a return on indices, who knows, it might make sense to just basically become, I'm presuming it's gold that you're trading. It might make sense to just become a pure gold trader and put your foot down on the gas with that. The reason being is I look at for expected value in everything that we take a look at. So any statistic that we're measuring, I'm always looking at how do I get my expected value to the highest it can be, and how do I reduce the negative expected value. So if you've got assets that you don't particularly trade well and you're producing negative return month after month, or if you're trading performance dips on a specific day of the week, again, is there a way to minimize that? Is there a way to look at the instances where our expected value is lower or negative and try and remove that completely from your trading? However, with this, there is nothing to amend right now. I just think you need more data. If you can get more data on indices and this pattern continues, I think you're okay. If over the next 62 trades, you know, the return is less than 1% or, you know, marginal, I would probably be looking at that and going, I've done, you know, 6 months of trading, 7, 8 months of trading to make such a small fractional gain. Would it make more sense to reduce the exposure there and allocate that exposure to trading gold or to trade in the assets where I know I'm more profitable? because sometimes it's not about trading everything just because you're positive. Sometimes it's about reallocating the risk. So if your expected value is much less over here, but it's much higher over here, sometimes you can save a bit of exposure and reallocate it out, redistribute that where you know it's going to generate a higher return. Now, moving down, we have trading time distribution. Now, this is a bit of an interesting one, but again, it aligns as it should, really. So the majority of your trading activity is during the European session, okay? That means the majority of your return is also in the European session, which makes sense. It's linear. The more trades, the more return. The only one that doesn't make sense really is the Asian session, but I can see that you're clearly trading like London through to late UK time, and therefore this just means you're getting up early and you're trading early on in the day. The great thing about that is it looks like you have a high expected value in that time zone, but there's just a lack of data. Okay, so what I would be doing with this is if we go, what's 591? Let's just work this out. 591 divided by 24. So there's 24. 591 is a 24.62 multiplier of 24. So if we do that same calculation onto the return, so if we do the multiplier times 0.86, we're looking at a 21.17% return. Okay, so this is all hypothetical. Please don't take anything away from this going, that doesn't make sense, that's wrong, yada, yada. This is all hypothetical. However, if this was to stay at the same pace and the same pattern, if you had the same amount of trades during the Asian session, you would have a return of 21.17% instead of 14.83%, which gives us a much, much higher expected value within the Asian session. The problem is the trade frequency is so low here that we don't know the integrity of the data. Was it just through a patch where trades happen to work out at that time? Is there an anomaly in the data? We just don't know because there's not enough to make a justified decision. However, having said that, these patterns occur for a reason. What I mean by patterns is patterns in data and the statistical patterns that we see. I would be 100% keeping an eye on this because you might find your hot zone is pre-London Open. Okay, if this continues over the next few months, over the next year, I would potentially look at scaling up my risk during pre-London. And again, all hypothetical. You might find that after a couple of weeks, this doesn't work, and it was just the early trades that you entered were, you know, through that period of time just happened to work out. So it's important that you monitor it closely. But if the pattern continues, I would say your expected value is much higher there, definitely than the American session, because 24 instead of 175 trading decisions, you've made, I don't even know, quadruple the return. And then again, during the European session, per trade or per trading decision, you're making a higher return on average, which means that you have a higher expected value for this one metric. So again, there's not much trading activity here. But if you're noticing, if you go through all of your old setups, look at the time of entry, try and find these trades, try and find the one that were really on early on in the day. Can you capitalize on them more frequently? Does it mean they have a higher win rate? Okay, because time of day is another variable. And the great thing here is, I always say that you have two different types of variables. Okay, you have a constant variable and you have a non-constant variable. The constant variable is something that is repetitive, and you know for certain in the future it's going to be happening again or coming back around. So for example, you know every day there's going to be a 12 p.m. noon. You know every day or every week there's going to be a Monday, Tuesday, Wednesday, Thursday, Friday. Every month there's going to be an NFP news event. Every month there's going to be a CPI for the US. Like, these are things that we can know in advance when and where they're happening, so it's a constant variable. And with those, it's very, very easy to go and find the data for them because you already have the data point. Now, the non-constant variables are things such as price. Okay, so you might have, best example I can give is, let's say $50,000 price point on Bitcoin. The first time the Bitcoin hit $50,000 and, you know, rocketed through, people would have been thinking, oh my God, this is it. We're going to the moon. Fantastic. You know, price is really good, yada, yada, yada. If Bitcoin tops at 60K and then tanks back through that level, it's the same variable. It is the same price point, but the market dynamic and the trader behavior and the trader feeling for the asset at that given time is completely different to, when it hit 50K, let's say 2 weeks ago. Okay, but the price point is the same. So we can't use a variable like a price point as a gauge for sentiment or as a gauge to be a constant variable, because it's not. 50K here, 50K there has a complete different meaning behind it. Whereas something like time, we know every day there's going to be a 10 a.m., 11 a.m., 12 p.m., 1 p.m. And so what you can do is start breaking your trades down by these constant variables and find your expected value. Whereas it's going to be much harder to do that saying, if I enter a trade at $50,000, is my expected value higher? You just don't know, because it's non-constant variable. There's so many differences behind the scenes that you cannot see just from that price point. Whereas with the constant variable, I can figure out my expected value when I trade between 10 to 11 a.m. every morning. All I need to do is log my entry times and I'll be able to see that data. Okay, so I'm a big fan of splitting the variables out. So the non-constants and the constants, figuring out your expected value on the constants and figuring out how to tie it in with the non-constant variables after, such as price point and chart patterns and all those sorts of things. Return distribution by day of the week. Now, this is an interesting one because Wednesday is clearly your worst day. It's hard to say this with confidence right now, just because you've got such a lack of data. So at most you've got 12 trading weeks. Okay, so you've got 12 Mondays, Tuesdays, Wednesdays, Thursdays, and only 10 Fridays. So the data set isn't huge, and this does take time to build up, because we need to build this up over a year at least to get 50 odd trading days. Of course, it's different because your Friday you don't seem to take as much trades. But you need a decent sample size on this to be able to take anything concrete away. However, again, it's all about pattern recognition and keeping an eye on this. Is this continuing over the long term, or was it just a short term anomaly, or has something happened to cause a spike in the data? For example, I always ask myself when I'm looking at these, why am I up 5.61% on a Thursday, but I'm down 1% on a Wednesday? Is there something there to take advantage of? By take advantage of, I mean not necessarily looking for more opportunity, but looking to refine the opportunity that you have right now. So again, it's very difficult right now to take anything concrete away from this, but if this pattern continues, there's a clear difference on a Wednesday compared to a Thursday. You might be taking the same trade. For example, the same chart pattern might be occurring on the Wednesday as it is on the Thursday, and you're executing it in the same way with the same size stop loss, same size target, same philosophy behind this trading decision. However, your performance is telling you have a much higher expected value on a Thursday than you do on a Wednesday. You have to listen to that, okay? Best example of this is, and I've been banging on about this a lot recently, is THA, who is the most capitalized trader at Darwinex. He has a negative return on a Monday over a 10-year period. But the majority of his return, I think it's something like 50% of his return was produced on a Thursday. So you've got 50% of his return coming in on a Thursday and then an actual negative day on a Monday over a 10-year period. Okay, so at that point, you start going, well, should I be trading Mondays when I know my expected value in this one variable is so much lower? I know I don't usually make money on this day, so why should I push size? Alternatively, you can start implementing something called a risk barometer, which again, the guys who come to these sessions on a weekly basis will know I talk about a hell of a lot. And it's where you find your expected values per trade or per variable, and you kind of slide your risk dependent on your expected value or your EV. So let's say we have a baseline of 1 and we put in a load of variables to our barometer, and we say, well, on this trade, I'm trading gold, which is my highest performing asset, during the Asian session, which is my highest performing session, on a Thursday, which is my highest performing day. So my expected value is far higher than if I'm trading, let's say, I don't know, in your example, let's just say euro dollar, where you have a negative expected value during the New York session, which is your lowest performing session, on a Wednesday. You go, well, actually, that's my lowest performing asset session and weekday. Do I pass on the trade? If I don't pass on the trade and still take it, should I be taking it with the same amount of risk as I do with the gold trade during the Asian session on a Thursday? I would absolutely say not. They're two completely different expected value positions. Okay, and yes, the one that has a higher expected value may lose. The one that has a lower EV might win. You never know. However, over time, it has that specific EV for a reason. And if you bet accordingly, and I use the word bet because bet is the best word, or if you risk accordingly or position accordingly, then over an extended period of time, your bet on the expected value should pay off. The best example of this is poker players. Poker players will never bet the same amount per hand that they have. They will wait until the cards are in their favor, which is a variable completely out of their control. They will wait until their variables or their cards have aligned, and then they will push their size, but only when they know they have a high expected value or a high edge. If they just have random cards and the guys they're playing with have a poker face and they can't read them and they don't have an edge in that moment, do you think they're going to push all their chips into the middle of the table and say they're all in? Or do you think they're going to pull back, fold their cards, take a loss or a relatively small loss and wait until their highest expected value? Of course, they're going to wait until their highest expected value plays, and that's where they're going to put size onto the table. Now, I don't want to get into the pedantics of poker and people saying, oh, yeah, well, people bluff, and I know people bluff, but just as a general rule of thumb, the better the hand of cards you have, the more risk you're willing to take. And I can see you already have a bearish bias, which I was very, very similar for a number of years, because you have a 59% short exposure over 400 trades almost, which basically means that you're taking, for every 10 positions, you're short 6 times and you're long 4. Daily trade frequency of 5.41, which is kind of medium frequency. It's not too frequent that we'd be going, well, this guy's just peppering trades all day. And it's frequent enough that you're still active most days in the market. You have a 69.87% win rate, so pretty much 70% win rate, which is fantastic. The only thing with that is you have a negative payoff ratio of 0.77, which basically means, for those who don't know what payoff ratio is, that is essentially risk to reward. So every losing trade, you lose 1% or 1R. Every winning trade, you make 0.77R. Now, you can, of course, be profitable in that, and I know many, many traders who are. However, you are forced to maintain a high win rate, which means that your recovery factor might be slightly lower, because if you do go into drawdown and have a certain amount of losing trades in a row, then it is going to take you a lot longer to recover than somebody with a higher payoff ratio and lower win rate strategy. However, that's not a negative. It's also not a positive. It's just your style of trading. My throat's really sore today, and I don't know why. I don't know if you can hear it in my voice, but just trying to power through. I'll keep sipping water. I think it's hay fever in the UK right now. Pollen is absolutely kicking everybody's backside. I've just noticed as well, you're ranked 209th out of 8,500 in DarwinIA Silver, so it's credit to you, dude. That's a good number. Now, what's interesting to me here is you have a negative duration ratio of 0.48. Sorry, it's not negative, but it's below 1. So your duration ratio is 0.48, which means your losers last longer than your winners. So you can see your average winning trade duration is 36 minutes, and your average losing trade duration is 1 hour and 15 minutes. Now, what this tells me is two things, okay? And this is probably the lowest hanging fruit I've seen so far on your Darwin. This is the thing that I would be straight away looking to improve. And you might wonder, why would I look to improve this? But there's two good reasons. This tells me that you either have a problem holding your winning trades. So your average winning trade duration, regardless of the payoff ratio, you're cutting your winners very, very quickly, and you're hanging on to your losing trades. Now ask yourself, why are you hanging on to your losing trades? Is there a way to figure out how you can get out of the market sooner? Because you have a high win rate system, I would be looking at ways that justify that win rate. Okay. And when it's not apparent in your variables or not apparent on your chart, I'd be trying to get out of the market as quickly as possible and trying to extend your winners slightly. We have an interesting metric on Darwinex. I'm actually gonna, I want to check it out now while we're talking about it. Is it IGJF? IJGF. IJGF. So we have open and close strategy here. And this basically measures if you was to stay in the market for 10 to 50% less time or more time in a trade, how would you fare? So your closing strategy, this measures when you're closing a trade. So there's three options where you would be outperforming what you currently do, which is surprising. I thought you would rank lower on this. If you was to hold trades for 50% longer, then you would be outperforming slightly. If you was to hold trades for 50% shorter, you would also be outperforming. And if you was to hold trades for 10% longer, on average, you would also be outperforming. Now, this is a very difficult statistic to get your head around. I also find it very difficult to explain it. There is an article on our K-Base, so DarwinX.com K-Base, where we explain this and how to optimize your strategy or at least how to test your strategy with this. But effectively, it's looking at do you open and hold trades at the right time, or should you hold off a bit or do it a little bit more aggressively? This tells me there's not too much difference between what you're currently doing and extending or pulling back your targets, which is interesting because I didn't think it would look like that. I thought there was going to be more of a low-hanging fruit here. The only thing that I can see is your entry points are suboptimal. So you can see your entry points are the lowest out of all 11 options. Now that means you could be getting into the market earlier than you are now by 10 to 50%, or getting into the market 10 to 50% after you are now, and you would still be outperforming what you're doing currently. So the potentially is something to take advantage of there. If you're getting into the market earlier, of course, your average winning trades are going to go up in duration. You've also got to be conscious that that might make your losers longer, but you should be able to we should be able to find a way to cut your losing, your holding time down on your losing trades. Which brings me on to this. Okay, so classic scalper. It looks like you have a bit of a hot zone within 30 minutes. So you win more trades. By far, you win more trades in this zone than you lose. The most active is 0 to 10 pips under 30 minutes. You've lost 50 and 131 trades. Okay, and I think that's pretty much the same story across this whole line. This is an axis that compares the amount of time that you're in a position to the amount of pips or return that you take in pips on that position. Negative on the red and positive on the green. As we go up, you can see there's less and less green and more red. Now, this tells me that you should look at implementing a time-based stop. Okay, so anything after 1 hour, we could pretty much cut all of these trades and you would be far better off. For example, you haven't won a trade after you've been in it for 8 hours. Okay, so we can get rid of that just by implementing an 8-hour stop. Now, if we take a look at the next, we've got 2 trades between 4 hours and 8 hours in duration. You've lost 2 trades, you've won 1. Again, you've got a negative expected value at that point. 2 losses, 1 win. Your wins are smaller than your losses as well. So I would be potentially cutting trades after 4 hours. Okay, let's work it down. Between 2 and 4 hours, you've won 4 trades, but you've lost 1, 2, 3, 4, 5, 6. So again, 4 winning trades, 6 losing trades. You've got a negative risk to reward. I would be cutting trades after 2 hours. Based on this information, of course, again, this is all hypothetical, and you know, make sure you're monitoring this over a longer period of time. However, at this point, I'd say you've only won 5 trades after being in the market for 2 hours. It doesn't make sense to hold positions after that length. The next line, we've got 9, 3, 1. So we got 13 winning trades. We've got 3, 4, 5, 6. 3, 4, 5, 6. 6 losing trades, 13 winning trades. At the risk to reward that you have, I would say it makes sense to still hold those positions. After 2 hours in the market, cut your trades. Okay? I'm not saying to go and do this right now, but go and run a sim test. Go and test out on all of your old trades. What would happen if I'd have cut them all after 2 hours? Okay, would I be in a better position than I am now? Because I can guarantee you probably would be. You'd have more losses down here potentially, but at least you would have cut the exposure before, you know, rather than just holding on to dead weight. Right, maximum positive and negative excursion per position. My favorite metric by a landslide. I always call it maximum adverse and maximum favorable excursion. It's hiding some data, so we can't see the asset that's being traded, but that's fine. We don't really need to. The main thing that I look for here is stability and consistency. I don't necessarily like large spikes because it tells me that you've either generated a large amount of return on one or two trades, which is okay. That's absolutely fine. But you have to ask yourself why that happened. And then I don't like the large red spikes because it tells me that some trades you're letting run against you massively. So, for example, I always get this little pen up so that I can annotate. What I like to do here is find my averages. So, pen. So if we say your average win is probably somewhere along there. I'm not too bothered with the wins right now. Your average losses are somewhere along there. Okay, so is there... That's an awful line. Let me get rid of both of them. I'm almost going to change color because the black's just not doing it for me. So is there opportunity? And there might not be. This is just an idea. Oh, my life, that line's awful. I'm going to try and do this quicker for you guys now. Ooh. That's even worse. However, point aside, is there opportunity to make your losing trades smaller? So, for example, if we know that our median negative excursion is 0.07%, which is somewhere up here, okay? It's a little bit too tight. Your worst negative excursion is 2.81. Why is there such a discrepancy here? There shouldn't really be that much of a discrepancy, okay? Because that is huge. So the average that your trades go against you is 0.07, okay? The worst that it's gone against you is 2.81%. That tells me that you probably didn't have a stop loss on that position. I could be wrong. You might always trade with a stop. But because it's so different to the median or to the average, I don't think that trade had a stop, which is a bit of a red flag anyway on its own. However, what I would say is find your worst case scenario that saves you from all of these trades. So we can say, I don't like that line again. If we can cut this, all of these, okay? If we can cut all of that drawdown, what would our performance look like? If we'd have implemented a hard stop at, you know, let's say 0.5%, you know, you might have cut, I don't know where these, that trade looks like it closed there. This trade looks like it closed at the bottom. This trade closed there. This one at the bottom. So you just saved all this drawdown, okay? And actually, in this case, none of these trades turned into winners, I don't think, apart from this first one. Okay, so you're saving all of this drawdown. Is it worthwhile putting not only a time stop, but also a max loss stop in the market as well? Okay, so that this is a little bit more tight here. Close that down right now. I like looking at your max excursions because it allows you to know if you should amend your entries or amend your stops. So are you risking too much on a position? Now, I don't mean percentage risk or dollar value that you're actually putting on the trade, but are you giving the trade too much room to breathe? If your maximum excursion, maximum negative excursion is, you know, 0.00 or 0.7%, let's translate that to pips for now. So 10 pips, but on every trade you're risking 40 pips stop. Does it make sense to risk 40 pips when the maximum that a winning trade went against you was 10 pips? Or does it make sense to scale your stop down to 11 or 12 pips? That way you're still covering your worst case scenarios for winning trades. And I know it's an easy example to pick out of thin air, but just to get the point across, does it make sense to scale your stop in so that it's covering your maximum downside, or even enter the market lower? If you know that the average every single trade moves against you is 5 pips, well, could you move your average entry down by 5 pips? Again, all things to think about, all things to play about with. Run sim tests with this. Don't be afraid to get stuck into your journal. Run sim tests. Change the parameters slightly. So, okay, we would have capped this at, you know, 10 pip loss instead of a 20 pip loss, which affects, you know, 30 trades, which reduces my drawdown by X amount and reduce it and increases my return by X amount. do these tests. Rather than just looking at a chart and going, how can I increase my efficacy on this technical variable? How can I find a new pattern, etc., etc.? Dig into your journal, understand what you do well, and if there's anything that you can do to refine your strategy. I genuinely believe that your max positive and negative excursion is the one metric that you can play with that can turn a break-even trader into a winning trader, and sometimes even a losing trader into a winning trader. Because one or two bad trades can literally wipe out your whole account if you're not monitoring your maximum adverse excursion. I'm going to apologize again, guys. My voice is absolutely killing me. I've been on calls all day, so my voice is kind of gone. So I appreciate you bearing with me whilst I'm struggling to get my words out. Your value at risk is okay. It's pretty stable, at least since the beginning of May. You had a sudden spike, which I'm not sure why that is, whether you increased your size or something. I'm not 100% sure. But ever since then, it's been pretty stable, which is great. It's at 17%, so I'm not too concerned about anything. Anything under 30%, I think you're absolutely fine. At this point, you're roughly 3 times as risky, or take 3 times much exposure as the S&P 500. I'd be pretty happy with that. I can see a question from Casey Courtney on YouTube. Do you use Ducascopy tick data suite or Darwinex tick data? Well, we use Darwinex tick data because it all goes through the Darwinex broker. I'm presuming that's what you're asking. If you're not, unless you're asking for backtesting purposes, in which I use both. Ducascopy goes back further, so you get more data. But I usually just use Darwinex tick data because the majority of my trading goes through Darwinex anyway. Let's take a look at Darwinex. So if you're not aware, you can view your zero Darwin on darwinex.com. You have to have an account. So, okay, he says, yeah, I use both too. Smart move. I like to say, if you use both and there's a big variance, then of course you've found something. You know that there's either an opportunity to take advantage of, or there's a strategy that's only working. Like, for me, it's a red flag for a system. If I'm coding an algorithm and I test it on Ducascopy and then test it on Darwinex and I'm getting different results, and I don't just mean, a small percentage difference here and there, all the trades are the same. I don't mean that. If there's a big variance and I go, there's something going on here that I can't quite work out, it tells me that there's an issue with a strategy, or there's a seriously good arbitrage opportunity, but that's very rare to find. But back to this, you can log into darwinex.com with your zero account, or create an account on darwinex.com and you can log into it that way, and then just go darwinex.com/Darwin/ your 4-ticker Darwin and a hashtag at the end, and it will bring you to your page on darwinex.com. So you can see we have a little logo here saying zero. So we know this is a Darwinex zero Darwin. Here you have some investable attributes. So this is where we break down certain metrics on your Darwin and we give you a score out of 10. So you can see on experience, you're currently scored 2.3 out of 10. It's not that you've done anything bad. It's just that we don't have enough data to say accurately that, what this guy has done over the past 4 or 5 months is going to be the same over the next 5 years. We just don't know. This will go up with time and with trading activity. That's all you can do to improve this score. It's not going to hinder you. It's not going to negatively affect you. Even when you're open to investors, we just need more activity. That's all. So just keep trading. Market correlation, you got 10 out of 10. This measures your effectiveness at trading both long and short. So generally, most traders have a high score of, I'd say, above 8.5 or 9. The only people that really struggle with this are long-only traders. Okay, so if you've got a long-only portfolio, of course, during a bear market, you're probably going to struggle because you're just going to keep getting hammered. And whilst you might still outperform the S&P, you still have a poor market correlation score because your performance is pretty much determined by the market direction. Next, we have risk stability, which is your value at risk chart. I'm presuming your score is so low just because of that jump at the beginning of May, but I wouldn't be too concerned about that because it's been pretty stable since. Risk adjustment, 9.9 out of 10, which is fantastic. This shows how often the risk engine has had to intervene in your trades. So if your deleverage oversteps the average threshold that it usually operates with, the risk engine can step in and close a certain amount of exposure, and you can see that from the orange and red dots over here. So you can see, for example, on this position, the risk adjusted 33.18% of the trade. So whether it closed that position or closed a certain amount of position, you can see on here. Oh God, tired as well. I don't know what's going on with me today. Next, we have the open and close strategy. But again, I would recommend you reading on the knowledge base. On the knowledge base, we have a page dedicated to open and close strategy, which are both shown on the same page here. We have open strategy above and close strategy below. Spend a bit of time digging into that, because I think there's a low-hanging fruit for you in terms of how you open your positions. If you can try and get into the market sooner or later, it might benefit you, but I'd do some testing around that. We then have the positive, negative, and duration consistency, which we've already covered on DarwinX0.com, which was the duration versus pip chart. So how many pips you take during how long you're in the market. It's just a different way to display it, but it's the same data. We then have our loss aversion, which is the maximum excursion chart, which we've already been over. We then have a performance chart, which is our in-house Monte Carlo test. You currently scored 10 out of 10, which is fantastic. You're on the 99.61 percentile, which is absolutely outstanding. This basically measures your strategy compared to 10,000 random strategies operating at the same risk level. Okay, so basically at this point, you're currently outpacing 9,961 other strategies, all using the same amount of risk. The thing I love about this chart is it gives you instantaneous feedback. If you start making changes to your strategy and you start dropping through the Monte Carlo, you know that, potentially the changes that you made, you might need to revert, or they're not working out as well as you thought they would. It kind of gives you that instant feedback to know what you're doing well and what you're doing wrong. And last but not least, we have capacity. You're currently rated 4.3 out of 10, but this is just a natural base of the system, showing how much alpha cap you have or what your max investment is. So if we just click all over here, what we do is we measure the toxicity flow of your orders to then figure out, okay, how much slippage would an investor be incurring at any given level of AUM? At that point, we would cut off your strategy if we know that an investor is consistently getting slipped based on the toxicity flow of your orders, giving us, the max estimated investment that you can handle before that happens. So you can see the divergence chart up here. So currently, well, on the Monday, the July the 7th, this updates every Monday, your Darwin was up 15.78%. But if an investor was getting 2 pips slippage on every trade, they would actually be down almost 3%. So that's like a 19% difference. No, it's about 18% difference there, which, we can't advertise your Darwin as being up almost 16% if an investor's getting slipped 2 pips and would be down almost 3%. Okay, so we have to cut off your Darwin at a point which allows the liquidity to get deployed on any given position. Okay, if we know that we're clipping your trades and there's an investor with 10 million, but they're going to be getting slipped because there's too much size to put through the market at any given time, obviously we can't do that. So we cut off your strategy at the alpha cap that you have. So as of right now, if we scroll down, you can see max estimated investment. Your max estimated investment or alpha cap is currently sat at $4.44 million, which means you can trade up to 4.44 million before you have to worry about hitting your limits and not being able to clip any more size on any of your trades. Generally, there's no kind of one thing that fits one thing fixes this for anybody or increases everybody's max investment. I would say the only general sort of advice I can give with this is trade assets that are highly liquid, trade during liquid hours. Don't close positions straight away. See if you can hold them for a little bit longer. Trade with lower size. It's kind of like general or common sense. It's kind of like common sense ideas here, which play a factor. If you're scalping with a 2-tick stop, then you're not going to be able to execute 100 million on that strategy, and therefore you're going to have a really low maximum investment of maybe 100k before the investors start getting slipped. Because if you're entering with 2-tick stops, it's highly unlikely that you're going to be able to fulfill your size at market. Anyway, guys, I'm going to call it a session there because my throat's about to pack in. So I really apologize for if this hasn't been as sharp as the previous sessions that I usually do. But if you wanna go back and watch this session, it'll be on our YouTube or X account, and I do have, or at least on YouTube, we have a whole library of these live sessions that I run, where we have welcome sessions. Appreciate that, Snowy. Rest more. I need to. Where we have welcome sessions, Darwin explanation sessions, where I go over risk and the concept of value at risk, etc., and these strategy development sessions, with more content coming soon. So I really hope that you took some value away from today's session. If you have any questions, please feel free to direct message me. I'm always available on Discord, apart from when I'm sleeping. So always feel like you can reach out to me. I'm always happy to have a conversation, and I'm happy to do this privately. If you want a one-to-one session, or you want me to record a video, I'll see if I can put aside some time and analyze your Darwin for you there. Guys, it's been absolutely fantastic. Thank you all for joining. I will catch you in the next session. Tomorrow, we're back at 3 p.m. to do a webinar on the Darwinex Index, which is our hedge fund that's just gone live. And we'll stick around for 4 p.m. tomorrow for our Darwin explanation session. So have a fantastic evening, guys. I will catch you in the next one.